Hey guys, welcome back. In this video, we are going to solve one problem from December 2023 question paper, lease accounting. Okay, this is from the lessor perspective. Lessor perspective problem. How much he is going to earn out of that lease, and how he is getting the lease payments, and what's the unearned finance income, interest income he get out of this lease leasing the vehicle. So these things and all we are going to see now. Okay, the story is lease limited. See, there is a lease limited. Okay, he has initiated a lease, so he has given a vehicle for lease. Okay, vehicle for lease costing rupees 20 lakhs. Okay, 20 lakhs is the vehicle cost. Okay, for 4 years. Okay, lease period is 4 years. Useful life is 5 years. Okay, then the asset would revert to the company under the lease agreement. The other information, okay, after 5 years, if the buyer is returning the vehicle to the lease limited itself, the unguaranteed residual income would be rupees 2,50,000, right? And the interest rate is 10 percentage, and the annual payments have been determined in such a way that present value of lease payment, present value of minimum lease payments, okay, present value of lease payment plus residual value, which is nothing but UGRV, unguaranteed residual value, which will be the cost of the asset. Okay, present value of UGRV. So they have given this statement. So with this we can proceed with the problem, and what they've asked us to find out is annual lease payment and finance income. See, nothing. The lessor is leasing the vehicle, 20 lakh vehicle to someone. Okay, at the end of the period, what he is going to get is the 2,50,000. So after the lease period, the vehicle have some value, no? So that is unguaranteed residual value. Okay. So then why it is called as unguaranteed? Because it is not guaranteed by the lessee. This is unguaranteed. If the lessor is selling outside, he will get this residual amount. So this is not will be paid by the lessee. Okay. Then let's quickly find out the present value of UGRV. Step 1, present value of UGRV is equal to UGRV into present value of 4th year. Since the money value is decreasing by day to day, so what we are doing here is we have 2,50,000 as the unguaranteed residual value. No, what's the 2,50,000 after 4 years? What's the value of 2,50,000? That's what we are finding out with the PV of 4th year. PV of 4th year is at 10 percentage, 0.683. If you calculate this, we get rupees 1,70,750 as the present value of UGRV. So we found out the 2,50,000 value in after 4 years, it would be 1,70,750, right? So now the next step is PV of MLP. What in the question they have given? PV of MLP is equal to cost of the asset minus PV of UGRV. We have a cost of the machine, cost of vehicle we have, minus what's the UGRV, present value of UGRV. Cost of the machine is 20 lakhs minus UGRV is 1,70,750. Okay, rupees 18,29,250, right? No, We have found out the present value of MLP also. What's the third step? What's the present value of MLP? Okay, after when we are issuing the any issue of issuing vehicle under the lease payments, the cost of the vehicle should match with the lease payments that will be periodically we are receiving. So I am receiving okay, for example, the lease period is 4 years and the vehicle value is 20 lakhs. I will be receiving 5 lakh as the principal, right? This 5 lakh I am receiving on I am receiving on the equated yearly installments. So when I'm receiving on a future period, how much the money values will how much the money value will be on second year, how much the 5 lakh money will be on third year. So that's what we are finding out here. So with the what we have done is, with the present value of MLP, with the present value of unguaranteed residual value, we have found out the cost of the vehicle is 20 lakh. And what would be the UGRV? What would be the UGRV is, present value of UGRV is 1,70,750. So when we deduct that with the cost of the vehicle, we get the present value of minimum lease payments. So this is the present value of minimum lease payment. The lessor should receive this amount. Okay. So if this is the present value of MLP, how much should be the annual lease payments? How much should be the annual lease payment that should be get by the lessor? Okay, annual lease payments is equal to present value of MLP. I know present value of MLP and divided by present value of annuity factor for 4 years. Okay, 18 lakh 29,250 divisible by present value of annuity factor for 4 years. What's the annuity factor for 4 years? 3.16987 divided by 3.16987, which is rupees 5,77,074 rupees. So this is the amount I should receive from the lessor. I should receive from the lessee to match with this amount. Okay, if I receive this amount only, I can recover this amount in future. Okay, so that's what the logic is. So we can go to the next step. So we found out the annual lease payments. So what would be the GAL? GAL is the entire amount will be received by the lessee for the lessor and paid by the lessee during this 4-year period. Okay, so 5,77,074 rupees into 4 years, right? Into 4 years plus what's the UGRV? UGRV is 2,50,000 that I am going to receive on 4th year. So what's the total GAL? 5,77,074 into 4 plus 2,50,000, which is, so in the period of lease for the 4 years, at the end I will be receiving 25,58,296 for the 20 lakh machine. Okay, so what would be the unearned finance income? Obviously 20 lakh is the, if 20 lakh is the cost of the machine, GAL is 25,58,290. The difference amount is 5,58,290 should be the unearned finance income. Unearned finance income means the lessor who issued the vehicle under lease, no. So he received 5,58,290 as a income for the 4-year period for the lease he has given. So that's it, the problem is. So I'll just quickly go through the problem again. So lease payments, lease limited has initiated the lease for 4 years and the lease payment has given the vehicle costing 20 lakh for useful life of 5 years. Okay, the asset would revert to the company under the lease agreement. Okay, and then the unguaranteed residual income is 2,50,000 that we know. Interest percentage is 10% we know. And what they have said is annual payments have been determined in such a way that PV of annual minimum lease payments, which is PV of lease payment plus PV of UGRV will be the cost of asset. So it means that there is no guaranteed residual value for this problem. Only there is a unguaranteed residual value and minimum lease payments. This actually forms the cost of the assets. Okay, we have a 5-step approach to simplify this problem. Okay, the first step is PV of UGRV. This actually contributes to the annual lease payment. So we have to find out the PV of UGRV. PV of UGRV is UGRV into what's the present value factor for fourth year. Fourth year is 0.683. So this amount is 1,70,750. When we calculate when we deduct that amount with the cost of vehicle, this is the actual present value of minimum lease payment we should receive. Okay, if we divide that value with the present value of annuity factor for 4 years, we'll get the 5,77,074 rupees as a yearly installment. The yearly installment that has to be received by the lessor. So we done that for 4 years. The amount should be received, and 2,50,000 at the end of the year we have to receive, right? So 25,58,296 is the GIL. UFI, which is unearned finance income, which is 5,58,290, right? Thank you.